potential. So, ang characteristics sa liability is na siya sa definition. First is present obligation. So, what does it mean when we say present obligation? So, present obligation does not mean nga kinahanglan nimo bayaran ang imong utang karon. But it means that you have the present obligation na you needed to settle within the year or beyond 1 year. So, present obligation means that as of the reporting date, an obligating event must have already occurred. So, it means na nanakay utang and then you have to settle at the reporting date. So, example lang na is ang utang. So, next characteristics is the settlement arising from past events. So, it means that, example ana is, nangutang ka gahapon. So, it means na kay present obligation na needed mo bayaran within the month or depende sa contract or sa sabot sa imong giutangan. So, present obligation arising from past event. So, next is outflow of resources. So, di ba, if magbayad ka, if nakai-settle na utang, it means may papalabas ka na pera. So, outflow of resources. So, to settle the obligation, you need to give up something. You need to, kailangan magpapalabas ng pera or you need to provide service so that to settle the obligation. So, an obligating event is an event that creates either a legal obligation or a constructive obligation. So first, legal obligation is an obligation that results from a contract, legislation, or other operation law. So example here is kanang mga tax. So, na naman siya sa law nga di mo bayaran. So that's why under siya sa legal obligation. Or kanang mga utang nga nabi ka kay gipirmahan nga contract. So under siya sa legal obligation. Another example here is kana contract to deliver goods. So legal obligation gyapon na siya. Next is constructive obligation. Is an obligation that results from an entity's action. So past practice, published practices that create a valid expectation from others that the entity will accept and discharge certain responsibilities. So, constructive obligation is actually dili ta siya obligation kaso kay gibuhat lang yun nimo. Kana bitaw, from the word constructs, it means nga na kay gibuhat na obligation na needed din settle. Example here is kanang mga promo bitaw sa Colgate, promo sa Coke, promo sa kanang mga alcoholic drinks bitaw na ay taklog. And then, likod sa taklog is nationality, text, something blah blah, then maka-receive din ka o igana. So, the moment kag-announce nila nga nanay nga na mag-promo, ang tawag na is obligating event. So, the moment na nag-announce ka o promo. And then, constructive obligation siya, it's because dili man required, but i-construct lang siya sa company para i-promote ang ilahang product. So, that is constructive obligation. So, liability recognition criteria. A liability is recognized only when all of the following are met. So, first, the item meets the definition of a liability. So, atong definition sa liability present obligation arising from past events that results in outflow of resources. Ito siya. Next is, it is probable that
in a form of a contract. So, a financial liability is any liability that is a contractual obligation to deliver cash or another financial assets to another entity. So, ang pasabot lang niya ani is if ang entity is mag-promise to pay another entity, kaya siya is obligation na siya sa entity to pay money or provide asset in a form of a contract. So, for example, ang entity is musugod siya sa isa ka contract sa other entity, which is, for example, construction company to build a park. So, katong money nga ilang na sabutan, it will be the financial liability nga kailangan bayaran sa entity. Next is a contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. So, nani siya situations where ang entity is pwede sila ma-exchange of financial assets or financial liabilities with another entity nga unfavorable siya sa parts entity. Example ani is example ako ang entity tapos kuha may contract nga mobile ko og akong financial assets bayluan og financial liabilities sa other entity, and that exchange will affect the entity unfavorably because pwede nga, for example, ang entity is actually short-term investment and exchange siya sa other entity sa isa ka long-term bonds. If ang market price is more rise, so ang bonds is less attractive nga it is unfavorable to the side of the entity. So katong loss nga magain nila ato is a financial liability on the part of the entity. Next is a contract that will or may be settled in the entity's own equity instrument. So if ang entity is naay utang, pwede niya ni-settle using its own equity shares. So pwede siya mag-issue og shares to pay the other entity for the obligation. So for example, nag-issue ako entity, nag-issue ko og shares para ma-fund na ko ang isa ka school. Tapos katudin ko ang other entity magbayad yan pala ito ng akong gi-issue nga share para maka-fund ko. So pwede niya ang other entity pwede niya i-convert ang bonds nga yung gipalit to cash or pwede niya i-convert siya sa shares. So kato siya nga is ito din mag-create ang financial liability. So examples of financial liabilities is accounts payable, notes payable, interest payable, loans payable, bonds payable, and bail bonds payable. So kabalo naman sa accounts payable, notes payable, and others. Pero murag ang bail bonds payable is medyo wala pa kasi nato na basinula sa uban, wala pa ka naka-ila. So ang bail bonds payable is, for example, ang entity is naa siya isa ka empleyado nga murag gikasuhan siya tapos if katong nga entity is mag-create siya contract sa bail bonds company para i-assure siya nga ang katong assailant or katong gikasuhan is mutunga sa court. If dili siya mutunga sa court, ang bail bonds company is magbayad siya sa court kay wala man siya dito nga. Pero pag mutunga siya, so wala ray bayaran ang bail bonds ng company. So kini siya payable ra siya if dili mutunga ang gikasuhan sa court.
So, initial recognition. A financial liability is recognized when an entity becomes a party to the contractual provisions of the instrument. So, a financial liability is something that a company owes. So, the company officially records the liability when they enter into a contract or agreement that creates an obligation to pay in the future. Like, for example, a company has to take out a loan. So, di ba, a company has to pay it back. So, when the loan contract is signed, the liability is then recognized. So, next is the initial measurement. Financial liabilities are initially measured at fair value minus transaction costs, except for financial liabilities at fair value through surplus or deficit whose transaction costs are expense. So, after recognizing the liability, the company measure its fair value. This is done at its fair value minus transaction costs. However, some financial liabilities like certain types of financial instruments or derivatives are measured attributable to the acquisition, issue, or disposal of financial instrument. So transaction costs are costs that are directly related to in acquiring, issuing, or disposing of a financial instrument.
Next is the subsequent measurement of the financial liability. So the financial liability is subsequently measured at amortization cost. So exact for the financial liabilities at fair value through surplus or deficit because it is subsequently measured at fair value. So first, what is amortization? So amortization, it is just like a depreciation. O galing lang, the depreciation itself is ginagamit siya to depreciate the tangible assets. While the amortization is gigamit siya para i-reduce or para it is a process of gradually reducing the book value of the intangible assets over its useful life. So para mas masabtan nato what is amortization, I will show you the illustration. So we have here the illustration. So on January 1, 20X1, the BTR issues a 5-year, 5%, 1 million bonds for 970,000 transaction cost on the issuance or bond issue cost amount to 12,124. The effective interest rate is adjusted for both the bond's discount and bond issue cost is 6%. So first, we will identify its initial measurement of the bonds payable. So first is the face amount minus the bond discount, which is from 1 million minus 970,000, it is equal to 30,000 minus the bond issue cost na 12,124. So our carrying amount for January 1, year 20X1 is 957,876. Or we can just simply subtract the bond issue cost to the 970,000 nga net issuance proceeds na given dito sa illustration. The same nagyapon sila na the carrying amount for January 1, 20X1 is the 957,876. So, the bond issue costs are not expense outright, but rather a deduction when determining a carrying amount of the bond similar to the bond discount. So, bond issue costs are amortized to interest expense over the term of the bonds. The amortization of bond issue costs increases interest expense. So, as we can see on the other slide, di ba ang bond issue cost is kanang wala siya dito gi-expense outright. Rather, gisubtract siya nato dito sa gisubtract nato siya para ma-determine ang carrying amount. So, to recognize the issuance of bonds payable to the BTR, so we will debit the cash in bank, local currency, Bangko Sentral ng Pilipinas, the is equal to 970,000, then credit discount on bonds payable, domestic, the 30,000, and then credit bonds payable domestic 1 million. And then to recognize the incurrence of bond issue cost by the BTR, so bond issue cost, I debit bond issue cost 12,124 and then credit cash in bank 12,124. So next we have here the illustration of the amortization table. So we can see here the date, the interest payments, the interest expense, the amortization, and the present value. So during the January 1, 20X1, the present value is equal to the carrying amount of the bonds payable. So on December 31, 20X1, dira pa dahil ka mag-start pag-solve or pag-determine sa amortization of that year. So, the interest first is the interest payments. So, that interest payments para ma-solve na is di ba ang interest is 5%. So 1 million nga bonds times the 5% interest, it is equal to 50,000. And then the interest expense. So 900 para ma-solve ang interest expense. So ang ato ang buhaton is ang present value sa January 1, i-multiply siya sa 6%. So maot it is equal to 57,473. So mao na siya ang interest expense for the year 20x1. And then para ma-solve ang amortization, so we can just simply subtract the interest payments to the interest expense. So on the year 1, we have the interest expense that is equal to 57,473 minus the interest payments of that year na 50,000. So our amortization for that year is equal to 7,473. And then para makuha na to ang present value sa year 1 or sa December 31, 20x1, so we can just simply add the present value of on January 1, year 20x1 to the amortization during the December 31, year 20x1. So 957,876 plus 7,473 is equal to 965,349. So ato aron i-follow ang process kung giunsa pag kuha ang diri sa year 1 and so on. So kung giunsa pag kuha ang process sa ang pag-solve sa amortization sa year 1 hangtod sa mag-mature na ang ato ang bonds payable. So para mabibala na to nga nag-mature na ang bonds payable is mahibala na to nga mag-mature na ang bonds payable if ang present value is equal na siya sa katong issue nga is equal na siya sa issuance cost. And then we have there the journal entry to recognize interest expense on the bonds payable. So debit interest expense 57,473. So ang kaning interest expense there is muna siya ang kato interest expense sa year 1, and then credit discount on bonds payable na 5,322, and then bonds issue cost na 2,151, and then credit cash in bank na 50,000. Okay, next is the allocation of amortization. So atong dumduman, the amortization is na-allocate na siya into two. It is equal to the bond discount and the bond issue cost. So diba, the 7,473 there is mao na siya ang amortization sa December 31, year 20x1. So para ma-determine nato ato ang isolve. So the bond discount, so we have here the carrying amount of the bond discount true cost. So subsequent journal entry follows the same pattern. To simplify the illustration, withholding taxes on interest payments are omitted. So para maibala na to ang allocations each year, so we can just simply follow this process.
So next, the recognition of financial liability. So it occurs when the liability is removed from the company's balance sheet because it is no longer a responsibility of the company to settle the liability. So the financial liability is recognized when it is extinguished, such as when it is discharged, meaning the liability is fully settled by paying off the debt, or when it is waived. So the creditors agree to forego the debt, meaning the company is no longer obligated to pay the liability, or when it is cancelled. So the liability is legally or contractually cancelled, or when it is expired. So the liability lapses due to the passage of time. So for example, if the liability is became unenforceable under the law.
So provisions, contingent liabilities and contingent assets. Provision is a liability upon certain timing or amount. So this means that it represents a fund that an entity put aside to cover anticipated future obligation. So a provision is recognized if all of the recognition criteria for a liability are met. If one or more of the criteria are not met, the item is a contingent liability, not a provision, and therefore not recognized as a liability. So as what Jinky said last time, that there are three criteria, right? So first is the present obligation, second is a probable outflow, and third is a liable measurement. So pag isa lang, either isa or duha ang kulang ani, pag dili siya ma-met, it is not considered as a provision. It will be considered as a contingent liability, and it is not recognized as a liability. Contingent liability is a possible obligation that arises from past events and whose existence will be confirmed only with the occurrence of non-occurrence of one or more uncertain future events not wholly within the control of an entity. So it is only the contingent liability is only a possible obligation if it arises from past events. So for example, an entity is facing a lawsuit and dili pa matukoy sa entity if makadaog ba siya or mapildi sa case. So that is na siya occurrence or non-occurrence of a future event. So pag ma-determine na sa entity nga makadaog siya or mapildi siya, dito rin nga contingent liability siya. Pag missing pa ang amount nga kailangan niya bayaran, it is considered still as a contingent liability. But if ma-meet niya ang tulong criteria sa liability, then it will be considered as a provision, not a contingent liability. So a present obligation that arises from past events but not recognized because it is not probable that an outflow of resources embodying economic benefits or service potential will be required to settle an obligation. So muna siya, if dili pa siya probable, it will be considered as a contingent liability. So the amount of the obligation cannot be measured with sufficient reliability if siya estimate reliably. Next is a contingent asset. So it is possible asset that arises from past events and whose existence will only be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of an entity. Same siya sa contingent liability, but ang ilang difference lang is ang contingent asset is a possible future benefit nga ilang makuha sa paan. So it is a potential future gain that can only be recognized when the uncertainty is certain na siya. Like, kanang napanagin nila nga, makuha nila ni siya ng case. So, summary is, contingent, if it is a liability, if the liability is probable, then it will be recognized and disclosed. It will be recognized in the financial statement and disclosed in on the balance sheet. So if the time value of money is significant, the provision must be measured at its present value. The discount rate used should be at pre-tax rate. So for example, a government must dismantle an infrastructure in 10 years and the cost is estimated at 1 million. And if the discount rate is 5% and the present value of this future obligation might be 913,000. So the 913,000 is the amount will be recognized as of today. So in measuring a provision, anticipated gains from the sale or disposal of assets should not be considered. So for example, if an entity sell an equipment to help fund a liability, this cannot reduce the provision by that expected sale amount. So the provision must be reviewed at every reporting date and adjusted if necessary to reflect the most current estimate. So if the obligation is no longer probable, the provision must be reversed. So for example, a provision of 500,000 was recognized for a prosecution. If a new evidence suggests the prosecution will likely be dismissed. So the provision should be reversed since the outflow of the resources is no longer probable. And if a provision can only be utilized for the specific expenditure for which it was initially recognized. So for example, a provision of 200,000 was recognized in the environmental cleanup. So the 200,000 cannot be used to pay the employee salary or any unrelated expenses because the funds must be used only for the environmental cleanup. So reimbursement. So if another party expected to reimburse the sum or all of that liability through an insurance policy or a legal agreement, this will create an asset known as reimbursement asset. So it is recognized and presented in the statement of financial position separately from the provision. So however, in the statement of financial performance, the expense related to the provision may be presented net of the reimbursement. So take note, the amount recognized for the reimbursement shall not exceed the amount of the provision. So for example, if a government entity faces a legal